Americans for Fair Taxation presents the Weekly Chairman's Report, written by Steve Hayes, president of Americans for Fair Taxation, and recorded by Bob Paxton, a volunteer with the Florida FAIRtax Educational Association. And now, this week's Chairman's Report.
Hello, I'm Bob Paxton with the AFFT Chairman's Report for Friday, April 30th, 2021. The income tax adds more risk to investments, and that's ridiculous. According to Investopedia, investing is the act of allocating resources, usually money, with the expectation of generating an income or a profit. You can invest in endeavors, such as using money to start a business, or in assets, such as purchasing real estate in hopes of reselling it later at a higher price. Now, whether buying a security qualifies as investing or speculation depends on three factors: the amount of risk taken, the holding period, and the source of returns. A Wall Street Journal article entitled Tax-Efficient Investing, Why It's Important, makes two important points. When it comes to investing, it's not just how much you make that matters. It's how much you get to keep after taxes. The Schwab Center for Financial Research examined the long-term impact of taxes and other expenses on investment returns and concluded that while investment selection and asset allocation are still the most important factors affecting your returns, minimizing taxes and other costs isn't far behind. Now let's look at the capital gains tax. Stocks, bonds, real estate, cryptocurrency, and other similar assets are called capital assets. For income tax purposes, a capital gain is the difference between what you paid for a capital asset and what you sold it for, well, assuming, of course, that you sold it for more than you originally paid for it. For example, if you purchase stock for $10,000 and sell it for $15,000, you've realized a $5,000 gain, which is taxable. Now, there are two types of capital gains, short-term and long-term. Under present tax law, a short-term capital gain occurs when an asset is held for less than a year before it is sold. Long-term capital gains are realized when an asset is held for a year or longer before it is sold. Now, ordinary income refers to any salary, wages, or fees we receive. Currently, short-term capital gains are taxed at ordinary income rates, while long-term capital gains are taxed at a lower rate. Couples making $80,000 or less pay no federal income tax on long-term capital gains, but these folks are in the 12 to 22% ordinary income tax bracket. Couples making between $80,000 and $496,600 pay a long-term capital gains rate of 15% compared to between 22 and 32% ordinary income tax rates. Couples with incomes over $496,600 pay a long-term capital gains rate of 20% compared to 35% to 37% for ordinary income. Now, if the stock that created a $5,000 gain was sold less than a year after it was purchased, then the gain would be taxed at the seller's ordinary income tax rates. But if the stock was held for a year or more, then the seller would pay no federal tax if their income was under $80,000. They'd pay $750 or 15% in federal tax if their income was under $496,600, and they'd pay $1,000, 20%, for those with incomes over $496,600. Now let's look at the history of capital gains taxes. Since the passage of the 16th Amendment and the introduction of income and estate taxes, the income tax rate on capital gains has changed often. According to an article published by the Motley Fool, with the exception of pre-1941 and 2004 to 2012, maximum capital gains tax rates have regularly been 20% or higher. Between 1970 and 1979, wealthy taxpayers paid between 30.2% and 35% on their capital gains. The current maximum rate of 20% is actually low compared to where things have been since 1941. Now let's look at the additional net investment income tax. This tax went into effect on January 1st, 2013. It's a 3.8% tax applied to investment income when total income exceeds $200,000 for a single taxpayer or $250,000 for married couples. This generally applies to any income from capital assets, rent, dividends, or gains from a sale. Like all of these income tax provisions, it's complicated. So the IRS has posted a 20-page document that provides instructions on how to calculate this 3.8% tax. Let's look at President Biden's proposals. Bloomberg has reported that President Biden is soon going to propose increasing the capital gains rate from the current 20% to 39.6% for people making over $1 million a year. Now, when you add in that 3.8% net investment income tax, these people will be paying 43.4% on their capital gains under Biden's plan. An article in the Wall Street Journal attributed the recent drop in stocks to worries about these significantly higher capital gains tax rates. The article stated that the S&P 500 fell 38.44 points, or 0.9%, to 4,134.98. The Dow Jones Industrial Average dropped 321.41 points, again 0.9%, to 33,815.9. The Nasdaq Composite slid 131.81 points, again down 0.9%, to 13,818.41. All 11 sectors of the S&P 500 traded lower on the report. Technology and other growth stocks were some of the biggest losers. Shares of Micron Technology, Twitter, and Western Digital dropped more than 4%. Now, many of us are invested in the stock markets, either personally or through our retirement accounts. In fact, it's estimated that 2/3 of the stock market is owned by institutional investors, including pension funds and retirement accounts. A drop in the stock market adversely affects all of us. In conclusion, the ruling class and their minions in D.C. are using their ability to manipulate the capital gains rates as yet another way to control us. Again, the bureaucrats in D.C. believe, with no basis in fact, that if they do a computer model, all of us will obediently act like the model says we should, and their rate increases will result in a corresponding increase in revenue. However, can anyone point to a point in time when the wealthy just meekly allowed their wealth to be confiscated? The wealthy have the resources to hire the best professional help and shield themselves from the full brunt of the proposed increases. Now, that's something the computer models just never seem to take into account. Now, it's also highly likely that many of the wealthy will respond to the proposed increases by selling their assets and taking their capital gains while the tax rate is still 23.4%. Now, of course, the D.C. group will decry that as unmitigated greed on their part, but in fact, that's just good, sound money management. When that happens, that's going to put further downward pressure on the stock market. And the sad fact is that the above drama is totally unnecessary. This could all be avoided if the ruling class and their minions in D.C. would just adopt a sane tax system, the FAIRtax. Now, here's what one U.S. president said about capital gains, quoting now, "The tax on capital gains directly affects investment decisions, the mobility and flow of risk capital from static to more dynamic situations, and the ease or difficulty experienced by new ventures in obtaining capital, and thereby the strength and potential for growth in the economy." End of quote. Who said that? Well, it wasn't Ronald Reagan, or any other Republican president for that matter. It was a Democrat, John F. Kennedy. When the fair tax is enacted, we can make investments because they make sense and not be worried about tax-efficient investing. Since there would be no federal income tax, there's no tax on capital gains per se. Those gains would be taxed only if they're used to make retail purchases of new goods and services. It's time that Americans take control of our country by eliminating the income payroll tax system. No more games that profit only the ruling class and their minions, the politicians. Enact the fair tax. So if you have friends who don't know about the fair tax, send them to FAIRtax.org. Have them watch the whiteboards under How It Works, and if they agree, ask them to please join us. Then, contact your members of Congress and the President and demand that Congress pass the fair tax, the only truly fair tax.
This has been the Weekly Chairman's Report, written by Steve Hayes. president of Americans for Fair Taxation. Check back every week for news and information about the fair tax and learn why the fair tax should replace our antiquated federal income tax system. If you'd like to receive a copy of the Chairman's Report in your inbox every week, sign up at FAIRtax.org.